The world of investing has never been more accessible, and yet it has never felt more overwhelming for those just starting out. Markets are shifting, new asset classes are emerging, and the traditional rules of wealth building are being rewritten in real time. If you have been sitting on the sidelines watching others grow their money while yours sits in a savings account earning almost nothing, this is the moment to change that. The good news is that you do not need to be a financial expert or have a massive amount of capital to begin. What you need is a clear strategy, a basic understanding of how different investment vehicles work, and the discipline to stay the course even when things get uncertain. In 2026, the economic environment presents both unique challenges and remarkable opportunities. Inflation has reshaped how people think about cash, interest rates have influenced bond and real estate markets significantly, and technology has democratized access to investments that were once reserved for the wealthy. Understanding this landscape is the first step toward making smart, confident decisions with your money. After handling debt and building your emergency fund, you are ready to start putting money to work. And this is not the most exciting part of the conversation, but it is absolutely the most critical. Think of it like building a house. You would not start with the roof before laying the foundation. The same logic applies here. The very first thing you should do is establish an emergency fund. This means setting aside 3 to 6 months worth of living expenses in a liquid, easily accessible account. This money is not meant to grow. It is meant to protect you. Without it, any unexpected expense, a medical bill, a car repair, a sudden job loss, could force you to pull money out of your investments at the worst possible time, locking in losses and derailing your progress. Once your emergency fund is in place, take a hard look at your debt. Compound growth means your earnings generate their own earnings, and over decades, this creates an exponential snowball effect that can turn modest monthly contributions into substantial wealth. And these two factors should drive every single investment decision you make. Risk tolerance is essentially how comfortable you are with the possibility of losing money in the short term in exchange for potentially higher returns over time. If watching your portfolio drop by 20% would cause you to panic and sell everything, you have a low risk tolerance. If you can stay calm and trust the long-term process, you likely have a higher risk tolerance. Neither is wrong, they're just different, and your investment strategy needs to reflect your reality. Your time horizon is equally important. If you're investing money you will need in 2 years, you cannot afford to put it in volatile assets. But if you are investing for retirement 30 years from now, short-term market swings become almost irrelevant. Time is the most powerful tool an investor has, and the earlier you start, the more you benefit from compound growth. In 2026, platforms like Fidelity, Vanguard, and Schwab offer excellent low-cost index fund options with no minimum investment requirements, making them perfectly accessible for beginners starting with small amounts. Here is why. Instead of trying to pick individual winning stocks, which even professional fund managers consistently fail to do over the long term, index funds allow you to invest in a broad basket of companies all at once. When you invest in an index fund that tracks the S&P 500, for example, you are essentially buying a small piece of 500 of the largest companies in the United States. If the overall market grows, your investment grows with it. The historical average annual return of the S&P 500 has been approximately 10% before inflation. That is a powerful number when compounded over time. ETFs work similarly, but trade on stock exchanges like individual stocks, giving you more flexibility. Both options typically come with very low fees, which matters enormously over time. A well-diversified beginner portfolio might look something like 60% in broad stock market index funds, 20% in bonds, and 20% in REITs or other alternative assets. Think of it as not putting all your eggs in one basket. While index funds already provide diversification within the stock market, true portfolio diversification means including different asset classes altogether. Bonds are one of the most traditional ways to balance a stock-heavy portfolio. When you buy a bond, you are essentially lending money to a government or corporation in exchange for regular interest payments and the return of your principal at maturity. Bonds tend to be less volatile than stocks, which means they can cushion your portfolio during market downturns. In 2026, with interest rates having stabilized at relatively elevated levels compared to the previous decade, bonds are offering more attractive yields than they have in years, making them a genuinely compelling option for conservative investors. Real estate is another powerful asset class worth considering. You do not need to buy a physical property to invest in real estate. One of the most overlooked advantages available to beginner investors is the power of tax-advantaged retirement accounts. In the United States, accounts like the 401k and the Roth IRA can dramatically accelerate your wealth building journey by reducing the amount of taxes you pay on your investment gains. A Roth IRA allows you to contribute after-tax dollars, meaning the money you put in has already been taxed. But here's the remarkable part: all the growth inside that account and all withdrawals in retirement are completely tax-free. In 2026, the annual contribution limit for a Roth IRA is $7,000, or $8,000 if you are 50 or older. If your employer offers a 401k with a matching contribution, that match is essentially free money. Contributing at least enough to capture the full employer match should be your very first investment priority before anything else. These accounts are not just savings vehicles, they are investment accounts where you can hold index funds, ETFs, bonds, and more, all while benefiting from significant tax advantages that compound your returns even faster over time. They are the ones who stay consistent, stay patient, and trust the process year after year. And the best investment strategy in the world means nothing if you cannot stick to it. One of the most effective habits you can build is automating your investments. Set up automatic monthly contributions to your accounts so that investing becomes as routine as paying rent. This approach, known as dollar cost averaging, means you buy more shares when prices are low and fewer when prices are high, naturally smoothing out the impact of market volatility over time. Avoid the temptation to time the market. Countless studies have shown that even professional investors cannot consistently predict market movements. Trying to jump in and out based on news headlines or gut feelings almost always leads to worse outcomes than simply staying invested.